Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with our friends Carol Massar and Tim Stenovec. Welcome to our audiences across Bloomberg Television, Radio, and our partnership for those folks streaming on YouTube. Guys, you remember back in late August, we had that run on the S&P 500 back above 4,500, did not hold that. We had another run to 4,500 just over the past couple of weeks, and now that is not holding. Now flirting with 4,300 here on what is the worst day for the S&P 500 since the spring.
Don't you feel like all the technicians are out there and like rethinking these numbers and rethinking what the trend lines maybe that are being taken out today? Because you've got all major U.S. equity benchmarks breaking below their 100-day moving averages. It's seen as a bearish signal by some of the technical guys. So it is interesting when we break out these levels. Doesn't mean things can't turn around, but nonetheless, I do have a feeling that the technicians are kind of rethinking where we go from here.
I was just saying to Carol, guys, that it's been a week where we've just had a lot of bearish voices in our studio. You're just joined by Hillary Kramer, CIO at Kramer Capital Research. And she is so bearish, she thinks that we could see another 5 to 7% drop this year in the S&P 500, and even was talking about the Fed cutting rates this year if the market sees that. I pushed back on it, but she was pretty insistent.
Cutting rates later this year, even after they just came out and said that they're reducing the number of rate cuts for next year?
That's pretty much what Carol said.
All right. Well, you know, I'm glad we're thinking alike here.
Totally.
I look at the indexes and how they are below these key technical levels. Volume, it should be noted here, is higher than average, about 6% above, I should say, the daily average for the last 5 days.
And remember, for all the changes, the upside changes that we've seen in price targets, a lot of those analysts and strategists have said that it is possible we could go back and test some of the year-to-date lows, and at least for today, we're starting to see that effect. The Dow Jones Industrial Average lower by about 1% on the day, down about 370 points, right around that 34,000 level, while the S&P 500 looks like it's going to finish the day right around 4,329, down about 72 points or 1.64 below that 100-day moving average. Similar story for the NASDAQ Composite, which is lower by about 1.8% on the day, and the Russell 2000 also lower by about 1.6%.
Yeah, Romaine, in a sign of the bearish sentiment and risk-off trade, look at the S&P 500, 465 names to the downside today, 37 to the upside, 1 unchanged. If you look at the NASDAQ 100, you've got 95 lower, Scarlett 6 higher for the day. So really investors not really wanting to even think about being even a bit bullish, it feels like, in today's trade.
Yeah, well, look at the...
Can I just say, too, this was one of those days where you had basically 90% of the S&P in the red, and that's something that is, at least as of late, has been relatively rare.
Absolutely.
And that shows up in the industry sector performances, too. This is the S&P 500's 24 industry groups. You can see everything is down. In fact, there are at least 8 groups that are down by more than 2%. So that's notable here. Real estate, investment trusts, retailers, and consumer durables and apparel, that's home builders, all down by 2.75% at least. The better performers, healthcare equipment, transportation, and household and personal products, your defensive sectors.
All right, a lot of red there. So it was a little tough to find some green, but I got an assist from my co-pilot here, Tim. FedEx, obviously, we broke down their earnings after the close yesterday, finishing way off its highs. Guys, it was up about 7% at its best levels of the day today, but finishing still with about a 4.5% gain. Top in the S&P 500 today. Profit topped analyst estimates, an increase to the low end of its earnings forecast. And I got to say, the analysts were out in full force. Evercore, Wells Fargo, Raymond James, B of A, Morgan Stanley, among those that raised their price targets on the company. Very positive on the company's progress in terms of cutting costs and also highlighting the strong performance at its ground unit. So the guidance is still conservative. So maybe looking for some more upside there in terms of the company's performance. Fox. Big story. I know you guys are talking about, we are too, certainly a big media deal. Earlier this morning, 92-year-old Rupert Murdoch saying he is going to step down as chairman of the boards of both Fox Corp and News Corp following a nearly 7-decade career. He's going to become chairman emeritus, his son Lachlan taking over as chairman of those companies. Fox up about 3% and top performing the S&P 500. How to do Splunk? it is obviously the target for Cisco, the takeout. Cisco buying Splunk for $28 billion, an AI play in a big way for Cisco, but also giving it more security for everything that runs on Cisco's infrastructure systems. Splunk, by the way, up about 21% in today's trade. But again, makes sense. It was the target. It was the takeout.
Okay, well, let's look at Cisco, the company paying $28 billion for Splunk, finishing the day down by more than 3.7%. 3.9% is the decline that we're seeing there. I asked Woo Jin Ho, our Bloomberg Intelligence senior tech analyst, Romain, why the stock was lower, apart from everything else being lower today, and he said that he was actually quite comfortable with the deal size. Oftentimes, though, we do see the company that making the big acquisition move lower on the day. He did say that on the call today, announcing this acquisition, some analysts were still looking for a company that has faster growth software company and more modern network architecture. The deal that moves the needle, right? Oh yeah, biggest deal in the company's history. Let's look at Amazon. It's the worst performer on a points basis in the S&P 500, leading a decline in mega cap stocks, down more than 4.4% today. Closed down for its sixth straight session, longest losing streak since February. The stock losing more than 10% over that 6-day period. And then TKO Group Holdings. This is the company that owns World Wrestling Entertainment, UFC as well. Finished the day down, close to 18%. Came after a new deal to broadcast its matches on the USA Network, disappointed some investors. Geetha Raghunathan saying that the new deal is estimated to be 40% higher versus the prior deal that was on Fox, slightly lower than the 50 to 70% hike seen in recent renewals. So a little disappointing that the company didn't get more money for these media rights.
Yeah, a lot of stocks down here on the day, a broad-based sell-off. The VIX elevated around 17, a sell-off in the commodities space, and a sell-off once again in treasuries, this time mainly in the belly and in the long end of the curve. You take a look at that 10-year yield right now at 4.48 and change right now, up about 8 basis points. We're higher by about 12 basis points on the 30-year yield. Now, you did see a little bit of a downdraft in 2-year yields, ever so slightly, down by about 3 basis points, excuse me. But I thought it was interesting, too. We had the latest MLive Pulse survey that was conducted immediately after the Fed's decision yesterday here. And in that survey, most of the participants, the majority of them, said 2-year yields have yet to peak.
So where do we go
raises
from
the question,
here?
Exactly. What's the next level?
Yeah, I mean, really, like, what are we at? 514 right now. So how much further can we go? We were up near, what, 5, almost 5.2 on it. So I don't know. What is the top point? And then what does it mean in terms of the Fed trying to get inflation lower? Like, do they need to kind of rethink, once again, that target that many say that 2% is not realistic?
They've been so clear that they are not going to rethink that target at all. I think it points to the fact that, rates are going to have to be higher for longer if inflation doesn't come down to that 2% target, Romain.
But it's a totally different conversation to say rates are going to be where they are higher for longer. It's another conversation if you actually believe that we haven't actually hit that peak yet. So you mentioned 5.14 on a 2-year yield. I remember there were people last week talking about that 6% was not unrealistic, and I kind of guffawed, I think, the first time I heard that. But now maybe I'm starting to become a believer in that as well. And then that gets back to what you were just talking about, Carol. You pull out your Excel spreadsheet or your TI calculator or whatever you're using to do your financial model. I know you don't do anything, Carol, but for those folks that do that, it changes the calculus.
No, it does. It's a major rethink in kind of how we do everything. We're going to talk with a bank CEO, regional bank CEO, and I'm just curious about whether he thinks that this is, kind of a rethink in terms of the lending environment, the costs of capital. Like, I keep thinking about the costs for companies and their debt loads, ultimately, if they have to refinance and so on and so forth. I mean, this changes the dynamics. It changes the equation. It changes the spreadsheet, if you will. It's a different environment.
And the cost for consumers as well. We've already seen mortgage rates top more than 7%. I mean, it gets ever more elevated in a market where there's actually no transactions because no one wants to give up their almost zero rate mortgages that they've locked in before the pandemic. So that combined with the resumption of student loan payments and other expectations that perhaps at some point the job market will soften or anxiety will rise is going to mean curtailment on consumer spending.
If we're on the topic of regional banks, are you actually going to keep your money in that bank if you can get a 5.5%, Romain, in a money market fund or at the short end of the yield curve?
Yeah, I am curious, guys. I mean, kind of what comes next here? Because the market was so focused on what the Fed was doing or not doing, and we've kind of seen, I guess, the end result of that. And, I mean, is it earnings? I mean, is that going to save this market, or are we kind of just listless for the rest of the year?
I think it's government shutdown. I think it's UAW strike. I think it's those things that are outside of the Fed's control.
I think it's earnings. I think earnings always helps us give us some clarity. If CEOs say, yeah, folks, we got it. But you know what? Look, Cisco did a deal. They felt confident to do it. We had IPOs this week. Like, there are still companies making decisions and doing things. And I think that's a really
we had IPOs.
But does this shut the door?
Three of those IPOs, three of those IPOs have already broken the price. I mean, to the downside. I mean, what does that tell you? I mean, it's good that they came in the market, but there's no enthusiasm in the secondary market right now for these.
Yeah, it might shut the door for further IPOs. All those Birkenstock, who knows whether they'll go public.
You want to go to Ruth Chris Steakhouse and get a cheap wine? What do you say?
Or a trip to Europe
if you're buying.
What about a trip to Europe?
As long as you bring your credit card, Romain, I'm in. I'm in. All right, guys, that's a wrap. Our cross-platform coverage. Talking about the markets on this Thursday. It's confusing, it's complicated, and certainly more to come. Our cross-platform, radio, TV, YouTube, and of course, Bloomberg Originals. We'll all catch you tomorrow.